Okay, hello everyone, and welcome back. My name is Greg Furman, and this is the Vantage Point AI Market Outlook for the week of January the 22nd, 2024. Now, to get started this week, we'll begin where we usually do with the US dollar index. Now, the dollar index getting a boost from some of these Fed comments. The economic data not overly supportive, but the good news is the Fed is going into blackout this coming week, so there'll be no more of this. The Fed and the Fed members in the committee continue to contradict themselves on whether they're holding, cutting, whatever they're doing with these rates. But again, we are going into that blackout, so we should see mainly range trading for the week. Now, our key Vantage Point T cross long on the dollar index is coming in at 102.70. I do anticipate a retracement of these level to this level based around the Vantage Point indicators. Our predicted neural index, the neural index strength, our predicted differences are, again, they rejected the zero line on the MA diff cross, but I believe they will circle back. The predicted RSI is starting to fall lower, but what's very interesting this past week is that the equity markets are the ones that are really pushing higher. With the some of the news coming out of the tech sector has obviously helped that, but all-time highs on the S&P 500 yet again. So we are recovering. We're holding above the yearly opening price on the S&P 500 because what's very odd with this particular trade setup is that inverse correlation. About 195%, the dollar index and the S&P 500 are inversely correlated, meaning one up, one down. They very, very seldomly go up and down together. So for the start of next week, the indicators do support additional longs on the equity markets and shorts on the dollar based on that strong intermarket correlation, if nothing else. Now, the key levels that we want to watch is that quarterly and yearly opening price at 47.45. Our T-cross long 47.52, so all of our support is sitting down at this level. If we look for a retracement point, that is the level we would watch, but the indicators are supporting additional longs. Now, with gold contracts, I guess I must have slipped a little bit last week. I've got a bit of the COVID brain still going here. But the gold contracts also are inversely correlated to the dollar index. So meaning dollars going down. If dollar goes down this coming week, then gold would start to rise higher. I've noticed a number of global central banks increasing, not decreasing, their gold purchases. So that favors gold, holdings in gold versus the US dollar. US still, I think, the highest reserve holder at about 69%, I think, of the world. I believe it's around 69% of the global gold reserves are still in the US. So interesting correlation or inverse correlation either way. The indicators from Vantage Point are starting to turn positive on gold, but we've got to get these predicted differences moving up. The predicted RSI above 50 and ultimately above 60 is what we're looking for, but we need that dollar strength. I don't think the market is going to commit to that until we hear what the Fed's next plan is on January the 30th or the 31st at the next meeting. But with that Fed blackout, it should indirectly help gold. Now, with oil prices, as I was talking over the previous week, in most cases, especially in the energy sector in the fourth quarter of 2023, very, very high positive correlation between the dollar and light sweet crude oil. So if the dollar moves lower next week, oil is likely to follow. However, either way, we're looking for that seasonal pattern in dollar strength starting around the beginning of February, and it usually lasts into mid-March. The dollar doesn't just go straight up or down. We still have our intraday trading, but the main thing right now we look at is that there is signs of weakness on the neural index strength indicator. You can see that it's pointing down. If we can break down below the Vantage Point T cross long at 72.83, or more specifically, the long predicted at 73.08. That's where all of our support is. So I would suspect, if nothing else, a retracement down to the yearly opening price just under that 72 level, and then be very, very cautious around that area, but watch the dollar index very closely. If it's aggressively moving lower, which I don't think it will be next week, it will likely move lower, but not a big move down, not until we see what this Fed is going to do. But if it does, keep an eye. There could be some good shorts, not just on the dollar, but also on our oil contracts. But that is the level 72.83. Then we've got our yearly opening price down to 71.71. A break of that would also mean that we've got a pretty significant dollar sell-off here if we connect the dots to the two. Bitcoin contracts under a little bit of pressure this week, like all other markets other than the US dollar. If the dollar rises, everything else goes lower. There should be nothing to mince in those words that I just said. Dollar up, pretty much everything else down. That's what we've seen a very strong pattern of in 2023. Whether we get the same in 2024 is left to be seen. But for now, Bitcoin finding some support along these verified support lows, these verified zones, 40,235. We're going to look for that area to hold. If it holds, then Bitcoin will remain in its uptrend. But we also have that very important yearly opening price at 42,501. I want to see us stay above this. I do think that Bitcoin will have another great year. Again, like I've said before on these webinars, is when Bitcoin is down 50% or more in one calendar year, the cycle pattern is to rally the next 3 years with a minimum of 50 to 100% rally each year. Last year we were up 100, I think 155% on Bitcoin. So if past patterns remain the same, we would be that strong again this year. So we'll keep an eye on this right now. We can see a very slow buy signal forming on our MA diff cross down here. Predicted RSI starting to recover, and I like the angle of that neural index strength, because we can see the neural index is still red, but the neural index strength is pointing up, and that's exactly what we're looking for. We then connect the dots to the verified support low, and I would like to see that level hold and then get back up above the yearly opening price. Now, as we look at some of our main Forex pairs, most of them recovering on Friday because, again, a lot of chatter from these different Fed members, each one of them saying something different. It's sending the dollar up, it's sending the dollar down. But again, the Fed blackout here is a really good thing next week, because at least we don't have to deal with that. So right now, I would anticipate a recovery in Euro US, but it needs to get moving. We're falling below that yearly opening price, 110.38. We do need to retake that, guys. That's a very objective way of looking at what a trend actually is. Below the yearly opening price, it's technically bearish. Above, it's bullish. But in most cases, a trending move doesn't start until midway through the first quarter. So we'll continue to monitor it, but for now, we again have another buy signal on Euro US, the neural index strength. The predicted differences of flat line, and they're starting to move up. Our predicted RSI is recovering. So we'll watch this, but we must get above 108.99, 109.28. That's where your resistance is for next week. If we can get above that area and stay above it, then we should be able to target the 110.38. But if we can't breach 109.28, then the euro will remain under selling pressure. Now, US Swiss franc has really got a push this week to the upside. I think it's surprised a lot of us, actually, because predominantly, again, the Swiss franc has done very well against the US dollar, despite the fact that it's still a carry trade. The interest rate differential between the Swiss National Bank and the FOMC still favors the US, but that hasn't phased this pair over the last few years, last multiple years, actually. So right now, we don't have a lot of resistance up here. Our next verified resistance high comes in at 88.21. I think it will be, it's going to be difficult for it to get to that level, I think. So the indicators right now are starting to roll back down, and that's what we're looking for. Now, in most cases, with that US dollar cycle, the dollar's strong in the first week of the new month up until the week after the non-farm payroll number. If we look at that scenario, in most cases, the dollar does sell off the week before the end of the month. And I believe it to be central bank rebalancing to some degree, or they're just setting the market up, getting them long the dollar, and then they pull the rug right out from underneath, or getting them short the dollar, I should say, and then pull the rug right out from underneath them the following week. So the scenario I would look for is a softer dollar this coming week leading up to the non-farm payroll number, and then the dollar goes higher either way in the first week of February. So we could see a limited rise here. The indicators are warning that it's losing what this 1 week of momentum, it is starting to lose that. Now, when we look at the pound dollar was a very interesting one this past week because the Great Britain cross pairs did extremely well. Great Britain, Japan, Great Britain, Australia, Great Britain, New Zealand, the list of them, Euro Great Britain fell lower, which again was Great Britain's strength, but Great Britain, US struggled. So we've retraced some of the losses from the beginning of the week, and we're around the break-even point, closing around 127.02. So again, we need to get moving on this. The indicators are basically sideways here. But the inflation data is still, in my view, there's more inflation in the U.S. in Great Britain than the U.S. or Canada, personally, but that could be debated based on the data. How is the data accurate? Well, that's highly questionable. Certainly out of the US, that data, economic data, you've got the CPI that's hot, then the PPI is not. And then the retail sales are hot, and then the next one's not. So it's a very mixed bag. But the payroll number will solidify that to some degree. But for now, we do need to get above this yearly opening price at 127.32, but I do anticipate range trading next week and the following week with the Fed. I don't think the major players are going to line up until they have some idea what this incredibly confused Fed is going to do next. So for now, we know where our T-cross long, 127 is our line in the sand. And if we can hold above 127, longs are good. But if we can't, then we're likely going to come back down and retrace this newly formed verified support low at 125.97. Now, as we look at the dollar yen, the carry trade, all I can do, guys, is warn you. The Bank of Japan is monitoring the FX move. They have told the market they're monitoring it because, again, right out of the gate, the carry trade kicks back in again, and we've got the dollar yen back up at the 148 level. So this is not going to be making the Bank of Japan very happy. So my only warning I can give you is yes, everything looks bullish, but at any time, intervention from the Bank of Japan could happen and could crush this thing lower. The earthquake situation seems to have settled down, so the repatriation there is should be okay there. But my concern that I would convey to you would be careful of this Bank of Japan. They are really watching this. And personally, 25, 30 years in the currency markets, I don't remember ever trading the yen at these levels. So the Bank of Japan, again, they kind of did it to themselves. These central bankers often shoot themselves in the foot, but be careful with this one. So if we get a little softer dollar next week, we could see a retracement back to the T-cross long in the 145.61 area. Our long predicted is coming in at 147.28. That's the level you want to watch. If we can hold above that, then we're not going to get to the T-cross long. But again, longs, while they're working this year, they're very, very high risk. Now, I believe next week we're going to see all eyes on the US Canada with the Bank of Canada. I am domiciled in Canada. I believe the Bank of Canada is going to paint a much more gloomy picture for the economy. The Canadian economy is not doing well. It hasn't been doing well for some time. GDP numbers have been down for months in a row, no growth. So there's no reason for them not to be talking about rate cuts. I believe that will be very negative for the Canadian dollar. So right now, We have our T-cross long. That level for next week is coming in at 134.12. And again, I would like to see us hold above this particular level, but the yearly opening price, which is very important, is 132.50. It would take basically the Bank of Canada is saying that they're going to hike again to get it down here. I don't believe the Canadian dollar can just ride the wave of oil prices, and if the intermarket positive correlation between the dollar and oil contracts remains steadfast, then that's another negative for the Canadian dollar. So possible falling oil prices and potential cuts coming from the Bank of Canada. Both big negatives for the Canadian dollar. So that's the fundamental, guys. Then we intersect that with the technical levels, and that long T-cross long, 134.12. Watch that area very, very closely. Now, as I've said before, I can do Aussie US and New Zealand US, but it is the same trade here, guys. And I believe it's being driven down here by what's happening over on this particular pair. Australia, New Zealand is made up of Aussie US and New Zealand US. So if this is going higher, then chances are, as I talked about last week, Aussie US. So I bought Aussie US this past week based on these Vantage Point indicators, and then it's moving along. So we've retaken the yearly opening price, 107.81. So potentially, guys, there's a very good looking long trade coming here. We just need to hold above that very important quarterly and yearly opening, and that's coming in again 107.81. So I believe that this particular cross pair is directly driving these two. So you can see that the Aussie has put a low in. That low came in on the 17th, and we've got a newly formed verified support low there. When we do a comparative analysis between that and New Zealand, you can see we have a low in also, but a very, very shallow bounce off that verified zone. It's barely even come off of that, and this illustrates how using cross pairs can actually be very effective in our Forex trading because Aussie US, New Zealand US, they're still heavily determined by, they're still traded against the US dollar. So is this here. But again, if this is rising, not only does it tell us if I'm going to buy, which one am I going to buy, Aussie US or New Zealand US, I'm going to buy Aussie US. And I, at the same time, would buy Aussie New Zealand, which is essentially the same trade. So just a slightly different way of doing things, but you can see that the Aussie is still struggling. There predicted difference in that, but it is gaining support from the cross pair. So with that said, this is the Vantage Point AI Market Outlook for the week of January the 22nd, 2020.